Hi, I'm Amy Jones, and I just want to remind you that I am not a financial advisor and I'm not a licensed professional. I'm sharing with you wisdom and education that I've gained over years of experience and the personal hardships that I also went through myself so that you can avoid or create a better life for yourself. Thank you so much. Hey guys, welcome to Financial Literacy. My name is Amy Jones, and why am I up here and what is it that I have to teach you? And what I have to teach you is that I'm a normal person that totally screwed up my finances. I was given the knowledge, I was given the education. My dad is a financial planner and a tax advisor. He started training me when I was 16 years old. He handed me a stocks and bonds book. He started teaching me the principles, drilling it into my head. I was his office manager for his consulting company. I was talking to people about their IRAs when I was 16 years old. Financial knowledge I was on point with. I knew what I was doing. The challenge was, when I turned 18 and moved out on my own and knew it all, that I ended up not being able to behaviorally apply the principles that I knew. And then I made myself wrong because I thought that I should do better because my dad taught me better. And then I didn't want my dad to know how bad I screwed up. So in 2008, I was living in California. I had chased a dream. I put everything on the line, and I lost everything. I sent my car back for voluntary repossession. I couldn't make my rent. I called an old employer and said, hey, if you guys will pay for my move back to Colorado, I will work for you like for a year. Like, can you just help me get home? Because I couldn't even afford to get home. And I got back here. I said, okay, I have to have a better financial foundation. I have to fix my structure. My credit score was in the 500s. I had no money to my name. I had a job, fortunately, because I had a good bridge with a previous employer. So I got home in 2008 and I started building one small step at a time. And it took a long time. It's kind of like gaining weight. You don't gain 50 pounds overnight. You don't lose it overnight either. You don't have financial growth or financial deficit overnight. It just doesn't work that way. It is over time. So when I realized that, I'm like, okay, I'm okay. Everything's okay. I have a car. I have a place to live because I bought a $1,000 car that the muffler fell off on a lot. I went from a position of renting a home, had the $1,000 car with a muffler that fell off, 500 credit score, no credit cards, couldn't get approved for any loans. Today, I have a 5,000 square foot home. I have 2 paid off, fairly new vehicles, and a total of 40,000 miles combined on both. I have 0 credit card debt. I pay it off on a monthly basis, and my credit score is over 800. And my goal is to teach you how I went from the point A to point B so that you can have that as well. So today we will start with the budget. So one of the major budgeting rules is know what you spend. So if you determine where you're at now, and most people have no idea where they're at, they want to avoid where they're at or they want to ignore where they're at. Some people like looking where they're at because where they're at's a good place. Regardless of which bucket you fall into, knowing where you're at now and where your money is being spent will help you make decisions in the moment. Do I really want to buy the $8 sandwich, or would I be okay with the $4 sandwich? Or do I make my sandwich and bring it from home? You know, it just helps those small decisions on a daily basis. Know what you spend on a monthly basis by looking at your statements. So if you don't know exactly what you're doing on, like, what do I spend on entertainment? It's amazing what we spend on entertainment. We have no idea that we did. What do I spend on food out? It's incredible. So there are many tools available to minimize the time and energy to track spending habits. So if you were to take your bank statement and actually take every single line item, even if you moved it into Excel and said, okay, this is entertainment, this is food, this is groceries, this is rent, it would take a long time to be able to do that. There are tools that you can download that automatically transact them. You can look at your pie chart on a monthly basis to kind of get an idea of where you're spending, and then you can drill down, like, wait a minute, how in the world did I spend $1,000 on entertainment? And then you drill down and go, oh, because I bought that thing on Amazon last month. That's how I did that one. But the big one I want to give you guys is the 50-30-20 rule. Have any of you guys heard of this before? Cool. So this rule is a very easy rule to apply for busy people to break down your income and how to budget. So with this generally works for people that make up to about $150,000. If you're over $150,000 in a year, you need to adjust this rule. So 50% of your after-tax income goes to needs. After-tax income is the income that you have after everything is taken out. So also consider any health insurance, any other benefits that are taken out of your check. Like if you make a net of $5,000 and you take home $3,000, this is out of that $3,000. 30% of your after-tax income goes to wants. And then the 20% of your after-tax income goes to savings. But what are needs? What are wants? And what defines savings? Because a lot of people think savings is under the mattress or in a bank account. We're going to shift that a little bit today. So in your needs, the 50%, these are the things that you have to pay for survival. So this would include your rent or your mortgage, car payments, maybe. If you don't need a car, if you can walk to work, this is not a necessity for survival. But if you have to have the car to get to work, that becomes a necessity. Your groceries, insurance, minimum debt repayment. So if you have a credit card and you have $40 a month that is due for your minimum payment, that would be a need. You need to pay your minimums. Your utilities. So these are just some of the examples, but I want you guys to get that needs are what you need to survive. Your wants. So on your 30%, so when you're prepping your budget, you go, okay, these are the things I have to pay. These are the things that I need to pay, but I don't have to pay. That would be a want. So these are not necessary for survival. Eating out, vacations, upgrades, better car, better groceries. Remember the $1,000 car with the muffler falling off? When I got a better car, that was a want. It wasn't a need. That car still got me from point A to point B. It served its purpose. Cable, and even in some cases, internet or high-speed internet. Gym memberships. Now, these, while they aren't necessary for survival, sometimes they are necessary for peace of mind, mental health, those kinds of things. But as far as a budgeting bucket, it goes in your wants. If you had to cut it, you would still survive. Doesn't mean you'd have a happy survival, but you'd still live. Now, savings. Savings is for emergency funds, debt pay down, and investments. This is a little different from what you'll see in a lot of places. So you want to build your emergency fund to $1,000, then pay down your debt above your minimums. So this is where you pay more than that $40. Build 3 to 6 months of emergency savings and never ever spend the rest. Never ever. Invest those funds to grow. Eventually you'll live off the interest from the investment and not touch the principal. And if you do it really awesome, you will end up transferring all those funds to your heirs when you're all done. If you're a little bit less than awesome, but you're mostly awesome, you can tap into that money as your retirement to supplement your income. Interest. So this subject is very fascinating because a lot of people don't know how interest works. So I want to break down the difference between simple interest and compound interest. And I want you to look at your statements on anything that you're earning interest on or paying interest on and find out whether it's simple interest or compound interest. Anytime that you're paying interest, so if you're paying, it is better to do simple. So simple interest. You only earn interest on the original principal. So let's say it's $100. No commas in 100. So if you have $100 and you're earning simple interest, let's say it's 5% per year. At the end of year one, you'll have $105. Make sense? Okay, so that's start 1 year. At the end of year 2, you'll have $110 because you're still only earning 5% of this amount each year. That is simple interest. So you'll earn your interest amount on your original principal each year. So you get an extra $5 a year. However, let's go into compound interest. So compound interest, you're an interest on principal and the accumulated interest. So with that same example, if we started $100 at 5%, so year 1, you'll have 105, right? Year 2, you'd have 105 times 5 more percent. What is 105 times 0.05? Times 1.05. Okay? Times 1.05. Okay, so in the first year, you're adding $5, right, each year, because it's 5% of 100 on simple interest. In compound interest, you're getting 5% not only on this number, but you're getting it on the outcome of the year. So you're getting interest for your interest for your interest. So compound over simple interest over time looks like this. Compound interest over time looks like this. So anytime you're investing, you want to make sure that you're putting it in some sort of compounding account. And that little word can literally make you thousands of dollars or hundreds of thousands over time. So would you guys rather have $10,000 today or a penny doubled every day for a month? Why?
Because it totals out to a whole lot more.
There you go. That's the difference between simple and compound. Then the rule of 72. So this will calculate how long it takes to double your initial investment. So what you do is you take your 72, just memorize that number, and then you divide it by your rate of return. So if it's 5%, it would not be 0.05, it would just be 5%. So what's 72 divided by 5? 14.4 years. So if you have it in a compound interest account at 5%, it takes 14.4 years to double. So if you have $100, it'll take 14.4 years to get to $200. If you have $1 million just sitting there, it'll take 14.4 years to get to $2 million. Now this only works with annual compound interest. So the rule of 72, while it can be very complicated mathematically, it can help you figure out where you are now and where you want to get later, and then how to actually create those goals. The big thing to really get out of the rule of 72 is that it doubles on average 72 divided by the rate of interest. So that way, it's one of those really easy things that you can put in place and go, if I need this much money, if I have a kid going to college and I need to plan for that child going to college, then I can take it and go, well, I'm going to probably need about this much money for that child to be able to go to school. And I have 18 years to plan for that. 19 if we're really on the ball, realistically maybe 10, right? And go, okay, to have that, what do I need now? Or what do I need in the next few years to be able to have that available? Savings. There are rules of savings. Save 20% of everything you earn. Now, when you go back to the breakdown, the savings goes towards First thing is what? Do you remember? Emergency fund?
Yep, $1,000.
Second thing goes to
Investment,
Debt, a little bit more than minimum payment.
anything above minimum payment will come out of this 20%. And then
3 to 6 months savings, emergency fund.
emergency 3 to 6 months. And then
investments.
invest. So, this emergency fund, priority number 1. After you have this checked off, the point of an emergency fund is to have it available when you have an emergency, right? So once that's done, you might be in this process of paying down any debt. But then you have an emergency come up and you have to use your emergency savings. What do? You take a break from your debt pay down, you refill this back to $1,000. Then you get back on track. So it's just step. Once your debt pay down is done, you've checked that off, then you go down to this one. Now, me personally, I actually have both of these. I have this available if anything comes up. And then I have this one available if life shows up, if anything major happens. I have ended up mentally relying on this emergency fund 3 times, but didn't actually touch it, which is really weird. But like in my thought process, I'm like, I'll be okay because I've got 3 to 6 months. I'm okay. But then I found other ways to end up not even needing it. But not having the stress was life-altering because that gave me freedom to go create other things versus scrambling to pay the bills. Investing gets really, 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 really fun. So 20%. So if you bring home $1,000, $200 goes into those buckets in that order. So 1, 2, 3, 4. Earned income is expected income from jobs, side gigs, and entrepreneurial endeavors. So save 20% of everything you earn. I'm adding something to that. Save 50% of everything you find. Found money is any money that you did not expect to receive. You get a bonus. That's found money, even if you know there's a bonus plan. If you get a gift, it's your birthday, you get $100. That's found money. I get that it's a gift. It's a gift of found money. Put 50% of it away. I have taught my children to do this since they were born. They have literally saved thousands of dollars. They're 10 and 12. But it's automatic. 50% of it goes away, and they just ignore it, other than this. But they don't spend it. If you implement that rule, your life will change. So break down. So build your base emergency fund first, then build your 3 to 6 months of emergency savings. But I want to be clear on what emergencies do not include. They do not include things that we know are coming in advance. So a lot of people think an emergency includes car maintenance. If you have a blown tire, then you weren't budgeting for replacing your tires. Tires wear out, it happens. Brakes wear out, it happens. Oil changes happen. Like, these are things that we know are coming. They are not emergencies. Birthdays are not emergencies. We know they're coming. Christmas is not an emergency. It happens every day at the same time every year. It's the most amazing emergency that I've had people go, well, I had to use my emergency fund for Christmas. It's not an emergency. If you didn't budget for it or you didn't plan for it, then you should make gifts. So these items should be in your budget. What else can you think of that should be in your budget that is not an emergency, but most people consider an emergency?
Home repairs.
Home repairs, that's a good one. Diapers, I have found, have been an emergency. Now, it's an emergency need. You absolutely need it. Formula. Yeah, you need it. But you should know that you need it before.
Yeah.
Kids eat and drink. They use the restroom. Be prepared. Clothes when kids grow. That one's a big one. Cars in general, if you're not making a car payment, one of the things that I like to do is make a car payment when I'm not making a car payment. Because then I will never borrow money to buy a car. I'm just pre-funding it instead of funding it when I buy it. Debt pay down. It should be task number 2 after your first $1,000, but prior to your 3 to 6 months of savings. It costs you a lot of money to have debt. That compound interest example, this is also how the credit card companies work. It's how your home loan works. It's how your car loan works. Anything that has compound interest, you borrow here and you're just paying them more and more and more and more and more over time. So the faster you pay it down, the less you pay them. You break from debt pay down to refill your base emergency fund when needed. That's the original $1,000. If you touch the $1,000, it becomes your priority. The goal is always to keep that at $1,000. Then pay down your debt, then build your 3 to 6 months. Minimum debt payments should be included in your needs bucket. This is only for additional pay downs above minimums. So if it's a $40 minimum payment, you pay that out of your needs bucket. If you want to pay down that credit card, then it comes out of your savings. Investments. Your primary residence is not an investment. It's not. As soon as your debt is paid and your emergency funds are full, then you invest the 20%. So after you go through all that stuff, you have your emergency fund fully funded. What do you do with all your savings money? That's when you just dump it into your investments. Invest these funds to grow with the rule of 72. Your goal is to live off the interest from your investments without touching the principal. If you can do that, then you can pass it on as your legacy. If you have to touch it in retirement, then you will ensure a comfortable life in your later years. Other things to consider. Your emergency funds should be extremely liquid, like you can get to them now. They should be in a savings account, quick withdrawal. You should not have to wait more than 24 hours to be able to get to them. Your investments should be in vehicles that use compound interest. So debt. What is debt? Debt is when a borrower borrows money from a lender. Whether that's your friend, it's a bank, it's a credit card, that's what debt is. Most debt is based on compound interest, which means you are going to be paying very highly for the use of somebody else's funds. Now, fun story, I did a cash advance on a credit card when I was 19 years old. And I did the cash advance for something that was unnecessary. But what I didn't know at the time is that the cash advance funds would be the last thing that I paid off, and all my other items that were like regular credit card uses would go first, and the cash advance was a much higher interest rate. And I got buried under that credit card for years because I couldn't get to the cash advance money. It was crazy. Secured debt has collateral. So some examples would be like a house. So when you buy a house, the house is the collateral if you use a mortgage. If you buy a car, the lender has title on the car until you pay it off. Unsecured debt does not have collateral, so that would be like credit cards, personal loans, as long as you don't put anything up for collateral. So if you have a secured debt with collateral, if you don't pay that debt, they can come take your collateral. If you have an unsecured debt, then they can chase you in collections, but they can't take anything from you. The biggest thing I want you to do in life is to avoid high interest debt for depreciating assets. A depreciating asset is something that loses value over time. So paying off debt, it's cheapest to pay by interest rate, and this is where a lot of philosophies differ. So if you pay off your highest interest rate first, over the course of time, it will be cheaper overall to pay off your debt. However, behaviorally and psychologically, it is easiest to pay off by debt amount, so you pay off your smallest debt first. So some people argue for good debt. So for an example, getting a loan to have a rental property. So you get a loan to buy a rental property and you're going to rent it out, and then you'll have cash flow and you'll make money, and over time it'll be an investment. It is good if you can carry the payment without a renter. If you can cover emergencies like a roof during a hailstorm. If it makes money after all the expenses. And when I say all the expenses, I mean property management, turnover, vacancy rate. You have to consider everything. In that sense, yes, it is good debt if it can make you more money than it costs. But you have to make sure you consider all expenses inside of that. Credit. Credit is one of my favorite subjects because with good credit, you get good access, you get good support. It's just this score that somebody made up that makes you credit worthy. So your credit is your financial reputation. Many people don't borrow money, so they don't have any reputation of how to pay it back. Your credit score is a measurement of your past actions. And approximately 40% of adults do not know how their credit score is calculated. They have no idea how they get the number. And approximately 20% of Americans have no idea what their credit score even is. They don't even know. So I want to teach you how they calculate your credit score. 35% of your credit is based on your payment history. This is on-time payments. So anytime you're 30, 60, 90 days late, it will reflect on your credit score and it will reflect on your report. Your utilization rate. So this one's an interesting one because there's two things to know about your utilization rate. First one is, it is the percentage used. So if you have a $1,000 credit card and you have a $100 balance, you're using 10%. So if you have a lower utilization rate, your credit score is higher. What they don't tell you is this balance is generally calculated on the statement date. So if your credit card statement is, let's say it's on the 15th of the month, whatever your balance is on that day gives you your percentage of utilization rate. So if you pay your credit card off the day before your statement day, this utilization rate will drop to almost zero. Biggest trick hack that I learned, I was like, oh, if I pay it on this date instead of the first of the month, my score went up 60 points. That's ridiculous. Why didn't anybody tell me, pay this thing off before the statement closes? Because they'll pull the statement amount for your utilization rate. Now, each credit card you have or credit card you have will have a different utilization rate, and then they'll average them out. 15% of your score is based on the average age of the account. So if you have an account for 6 years, and then you go, you know what? I want to add another account. When you open the new account, it starts at 0. They will average it. Your credit is now 3 years old. So you want to open as many as possible in the beginning. If you're not using this one anymore and it doesn't have an annual fee, don't close it. Keep it open because it's making a difference here. Does that make sense? So if you have a credit card that you never use but is 10 years old, put a recurring bill on it. Put a cell phone bill on it. Put a internet bill on it. Put a cable, one of your wants. Put a want on it. Pay that off every month instead of the bill, just so it's staying active, so that it impacts your average age. So 10% is based on your type of credit. So revolving accounts, installment accounts, open accounts. Revolving accounts would consider things like credit cards, anything that is revolving. Installment accounts are something that you pay installments over time until it's paid off. Your open accounts are anything that you still owe money on. And then your credit inquiries, this counts on hard inquiries. There's a difference between soft and hard pulls on your credit. So if you're talking to somebody and they're going, hey, I would love to finance you for this. Don't worry, it's a soft pull. What that means is that that does not go against your credit report. A hard inquiry will go against your credit report. And you want to keep those limited over a specific period of time. They usually last up to about 2 years on a report. Taxes, our favorite subject. Okay, maybe not. So, your income is taxed at the percentage of the tax bracket you qualify for, but most people don't know what this actually means. So if you look online, you can find like a tax bracket, and it might say, I'm going to use, it changes every year based on inflation, but usually it's like, 10%, 12%, moves up every year, right? But it'll say, hey, up for the first $45,000. Or it'll say like this number to this number, so 1 to 45 is 10%. And then it might say 4501 to 62. These are not the actual numbers. I know they're not the numbers. I'm doing this for demonstration purposes. So most people think that, well, if I end up making $47,000, my entire $47,000 is taxed at 12%. Does it actually even make sense for me to get that $2,000 raise? But that's not how it works. The first 45 is taxed here. Additional money from 45 to 62 is taxed at 12%. So at 47,000, 45 of it will be taxed at the 10, and 2 will be taxed at 12. I want you to be aware of that because most people dig into that and go, well, that doesn't make any sense. It absolutely does. As you go up in brackets, when you're down in the 250 range and you're paying, 30%, you're only paying 30% on that amount above. But you're not paying more on this part than anybody else. So as you increase in income, your additional income is taxed at a higher rate. So tax brackets are adjusted annually. They're based on inflation and filing status. So whether you're filing single, married, those things will make a difference. So some basic tax saving techniques, some retirement accounts, a health savings account, charitable deductions. These are just a couple of things you can do to reduce your taxable income. However, each of these things you want to dig into further because retirement accounts go into an entire wormhole. Health savings account makes sense for some, not for all. If you have a prescription on a monthly basis that you always pay, a health savings account would allow you to be able to buy that and not have to pay tax on those funds. But if you're not guaranteed to pay the money every year, you might lose the benefit of it. Does that make sense? Retirement. It's where we all want to get to someday, right?
Yeah.
So we're going to go a little bit in depth on some retirement accounts. Individual retirement accounts, or IRAs. There are two major ones. A traditional IRA, which grows tax deferred. Contributions are deducted from your tax return. So what does that mean? That means if you made $80K and you contributed $10K, your taxable income just became $70K for that year in a traditional IRA, which means that you get to discount this when you file your taxes the year that you contribute. And then they will grow, so this $10,000 will grow for however many years it's in there. You will not pay taxes on it anywhere through here. You do pay taxes when you pull it out. So that means as it's growing, so you put it in, you don't pay taxes on it. While it's growing, you don't pay taxes on it, but you do pay taxes on the total number that comes out the other side. Roth IRAs grow tax-free, but you pay taxes on the income before they go in. So this is a traditional. Now, on a Roth, if you make $80K and you contribute $6,000, there are limits on them on how much you can put in per year. You would still report to your tax $80K. It's still your taxable income. So that's the major difference. Your taxable income on a traditional is 70, on a Roth is 80. Then you take this one. You grow it through the years. You don't pay taxes on it while it's growing. Then you get it out here, and you pay no taxes when you withdraw it. So this is pay tax because there's no tax. So here's the difference. This one, you get the benefit today. This one, you get the benefit later. There's good reasons and pros and cons for both of these accounts. There are different limits and rules for each type of IRA, and you'll need to determine what works best for you, or a combination of both, because you can actually have both of these accounts. You just have to make sure that when you have multiple accounts that you follow the overall rules of combination of how much you can apply. So these were created as a tax benefit for people saving for their retirement from the government. Then we have 401ks. So 401ks are company-sponsored retirement accounts. So 401ks are offered by some employers. They are not a requirement of an employer. They are a benefit of an employer. Some employers will match a percentage of your contributions. So they might say, hey, we will match 50% up to a portion of your salary or a portion of your income. It just depends on how their rules are set. It would be in your employment agreement. Traditional 401ks, we also have traditional and Roth 401ks, just like the IRAs. They are pre-tax contributions, but later your withdrawals are taxed. In Roth IRAs, they're after-tax contributions, but later withdrawals are tax-free. So really you're determining whether you're paying tax now or later. If you can pay the tax now and grow it, you will actually pay less tax. If you pay tax generally. If you pay the tax later, it will be a higher amount because you're going to pay taxes on the gains as well. And there are annual limits on 401k plans as well. So there's only so much that you can put into each plan, and those limits change on a yearly basis, so you kind of want to keep track. And it depends on what the economy is doing, what the health, they'll change the rules based on that. Insurance. So insurance is the thing that we don't want to have to pay for, but we want to have in the moment that we need it. So life insurance, there's two major life insurance types, term life and whole life. Now, if you're looking at life insurance, generally speaking, unless you have somebody depending on you, you don't really need it, other than enough to cover your funeral expenses or anything like that, so you don't impact your loved ones. But if you don't have dependents or anyone who needs your income, you may want to consider waiting on life insurance. Term life insurance is more affordable than whole life. It generally costs about 7% of the premium than whole life. There's no cash benefit to term life. You want to plan on 10 to 12 times your annual salary. So if your annual salary is $100,000, you want about $1 million in term life. If it's $50,000, you want about $500,000 or a little bit, $600,000. So 10 to 12 times. There's a reason for that. So with your 10 to 12 times, if you're at, let's say you're at 100,000, if you do 10x, that would be $1 million. The point of that is if you can put it in a 10% account, you can keep the principal, and then they can use this money to replace your income without having to touch the principal, so that they have time. Does that make sense? So it's kind of like replacing you and your work with the money and having the money work for it. The pros of term life is that there is this income replacement upon death. There's ability to do debt payoff. The cons is that it's costly to renew. So if you're 30 years old and you get a term life for 10 or 20 years, it's set price for that time period. So let's say it's 10 years later and you're 40, you're not going to get the same price. You're going to get the 40-year-old price. And 10 years later, you'll get the 50-year-old price. So it starts going up. Every time you renew it, it'll effectively what they do with life insurance is they kind of take, the younger you are, so let's say you're over here and you're, I don't know, kind of goes like this. So here's your age, say 20, 30, 40, 50, 60, and this is your premium over time. So if you get it here, it's pretty cheap. Here it starts going up because your likeliness of dying goes up as you age. So whole life insurance. generally has a higher premium than term life. Again, term life is usually, on average, if you go and statistically check it, it's about 7% of the cost of whole life. So you'd pay $7 for term life, you'd pay $100 for whole life. There is a death benefit, and there's a cash benefit. So the pros for whole life is that you are covered for life, and your premium is guaranteed. It will never go up. And you can borrow against the cash benefit, but you do have to pay interest to borrow your own money. And I say borrow your own money because you're the one who paid in to create that cash benefit in the first place. The cons are that it is expensive, and the premiums are guided by insurance. So commissions get paid first, death benefits get paid first, as far as your actual premium amount and where those funds are allocated before you can withdraw. Health insurance. So this insures against high-risk, high-cost events with catastrophic long-term consequences. You're typically covered in part by employers and part of your compensation package. So if you have health insurance, that is part of your pay. Disability insurance. Disability insurance files protection against certain disabilities, either mental or physical. You must be determined unable to work to be able to claim this, and generally only receive a percentage of your salary, and normally, I've seen it normally around like 70%. For car insurance, this covers bodily injury or property damage up to your limits of your policy. Underinsured and uninsured covers bodily injury or property damage not covered by other insurance or the responsible party if they are not you. Homeowners insurance. There are two major parts of homeowners insurance. HO2 provides broad coverage on dwelling and other structures on property. The dwelling would be your actual home. And it only covers what is listed on the policy. HO3 covers the home, personal property, and liability, and covers everything except what is listed on the policy. Renter's insurance reimburses for loss of personal property owned and kept in the location being rented, and generally must be able to prove items existed to be covered, so you have to have photos, receipts listed and reported to the insurance prior to the insurance event. You have to be able to say, hey, I own these items and here's the proof that I own these items. Umbrella insurance is one of my personal favorites. This can provide coverage when homeowners, auto, and other policy limits are exhausted. That means that you've already used the limits. Umbrella insurance comes in next. And it can provide coverage for claims that may be excluded by other liability policies such as lawsuits. So if my daughter harasses somebody on the internet and I get sued for slander, my umbrella insurance will cover that. Make sure you know what your umbrella insurance covers. If I'm in a car accident and my car insurance maxes out, but it still has further to go, my umbrella insurance will cover the gap. Umbrella insurance is amazing. Insurance benefits. Insurance gives you peace of mind. It gives you stability in otherwise difficult times. It's generally required by lenders when funding loans. So, additional resources. So for budgeting, my favorite personal budgeting tool is Rocket Money. It's a $3 a month premium app. It's free if you don't go premium. You can connect it to all your financial accounts and it will do that dashboard for you, which is really awesome. You know exactly where all your money is going. For interest calculations, there is a really cool website that is my favorite. It is calculator.net/interest-calculator.html. So if you're trying to run your 72, you want to know what it's going to really cost, you want to know what growth is, really fun calculator. For debt and credit, annualcreditreport.com. You can get a copy of each of your credit reports for free once per year. This is where you get it. If they charge you money or try to give you a bunch of stuff or have a whole bunch of ads, that's not where you get it. This is the site that you go to, period. Credit Karma. Credit Karma is my personal favorite because it helps teach you how to manage your credit while you're learning or while you're managing your credit, and it gives you the breakdown and it'll show you like the different tools. Now it doesn't say, hey, 35% of your credit score is this. It says, hey, this is a high impact. You're like, oh, I should pay attention to that. Now, I think it does it in correct order of percentage. Credit Karma is my favorite. Remember, work hard, save hard, then play hard. This event is sponsored by Nob Hill Towing.